Hello, Black investors. Welcome to this discussion on how to find money for your real estate deals. I always start out with a legal disclaimer. I'm not an attorney, accountant, economist, or financial advisor. Any information I provide is not a promise of returns. You're responsible for conducting your own research and due diligence before investing, with the understanding that all investing has risks. If you're interested in any investment opportunities, come let me know so I know how to advertise. But also, as we will talk about later, it's important for me to determine suitability, to know what your risks are, what your return requirements are, what you're interested in. So if I come across a property, then I could know if this makes sense for you and where you are and what you want. And then again, legally, I have to be very careful about how I advertise depending on what type of funds that I'm raising. Just a little bit about me. I'm from East Oakland. I've been focused on improving communities through real estate development, and that landed me working for the government, where we invested in new construction and rehab of affordable housing apartment buildings. I funded 40 projects worth $1 billion, and I was also an asset manager of 4,000 apartments of both affordable and market rate units. And an asset manager oversees the property manager. They think about higher level things like when to sell, when to buy, when to do a rehab. Property managers are more day-to-day dealing with tenants and leasing and maintenance. I'm a licensed real estate broker, and I currently find and analyze apartment deals for myself and other investors to buy. So I'm always going to do the recap and progress report because I don't want us to get lost. I want us to keep focused on why we're even here, why you even want to buy property or invest. And it all depends on your goal. And everybody has a different goal. Some people want immediate cash flow. They want to get a retirement fund going on for when they retire. They want tax breaks. They want to buy a small place for each person in their family to live in a unit, or they're looking for something very long-term that they're not going to live in or use, benefit as an inheritance. And all these things will determine what type of property you buy, where you buy, how much you invest, how long you hold it, your whole strategy. And then education is important because if you don't understand what you're doing, how to invest, first of all, the fear will overtake you. You're not going to do anything. You're just going to make excuses. And if you do go ahead without understanding really how it works, then you're going to make a lot of mistakes and some very costly mistakes. So learn as much as you can. Go to meetups, read books. You can get all the information. People are just giving information for free. And then saving. Saving is really important. You have to have some money to invest when an opportunity comes along. Building relationships will allow you to, one, find properties. People find properties through relationships. They get their money to fund their properties through relationships. The maintenance crew, the property manager, the construction people, all by connecting with people in the industry that will help them achieve their goal in buying apartments and managing them properly. Got to get over trust issues. You got to work with other people. So it's best to keep looking for people who you can trust and have integrity. They're out there. And then sharing information with other people and with your children. So we have this thing where we, along with our trust issues, don't really understand how to share and the importance of sharing information. This is why people go to the golf course. A lot of times they aren't really playing golf, they are, but they're talking about business, they're sharing information. And that's how they help build economic and financial literacy and understanding among their friends and among their community, so that person can take the information, use it, and generate wealth for themselves. So that's why I'm sharing information, what I've learned. I have nothing to hide. I want everybody to do well. So I share whatever I learn, and a lot of things that I know people have told me. And share with your kids. When they get about 12 years old, they're ready to start learning about financial literacy. The younger, the better. Saves them mistakes and really gets the fear out of them. So when they're 18, they understand finance and investing, and they can make decisions and start building their wealth earlier. So overcoming our trust issues as a community prevents us from working together, which is key. We have to work together. Everybody who does any type of significant investing, they have partners that they work with. And then me knowing that and being aware of our trust issues that have been entrenched for hundreds of years. I'm determined to find people, Black people in our community, that we can work together and help each other. A part of that means reliability. So I'm committed to being reliable. I'm committed to starting on time. I don't do CP time. I respect other people's time, and I'm going to do what I say I'm going to do when I say I'm going to do it. And part of that is starting on time. The other part of it is being transparent. If there's anything that I'm working on, I like to be totally open about what I'm doing and answer anybody's questions. And over time, hopefully, as we get to know each other, that will build trust and find people that you can work with. So I'm going to start off with some definitions and distinguish some of these terms that people may know but not really sure about. So the first is the difference between equity and debt. So when you buy property, it's paid for with either equity and or debt. Equity is just cash that people put up, they put in the property, their down payment, and it's money that they put at risk of losing. And in exchange for risking their money, they're getting an ownership share and also unlimited upside. So people can lose their money, equity investors can lose money, and they might never get it back. This is different from debt, which is a loan with a fixed interest rate or rate of return. And because that lender is getting that very specific interest rate and a certainty, they have it's lower risk for them, but they are having their rate of return capped. It's 3% or it's 5%, whatever you agree, no more than that and no less. So their risk is lower. And they also have a way to get their money back through either foreclosure or going after you personally, depending on what type of funding it is, if you don't pay the mortgage. Recourse versus non-recourse debt. So recourse debt is when a lender can come after you personally to claim a debt if the property is not enough to satisfy. So first you got to pay the mortgage. If you don't pay the mortgage, then they can go through foreclosure process, sell the property. If they don't get all their money back from the foreclosure sale, then they can come after you personally and get the money, which they may require you to sell assets. Your personal assets are at risk when this happens. Non-recourse debt is when a lender can only come after the property. So if they go and sell your property at a foreclosure and they don't get all their money back, then that's too bad. They can't come after you personally. General partner versus limited partner. So when you get funds, equity funds, you're going to get it from a general partner or a limited partner. General partners are owners. They have, and so are limited partners, but general partners are equal of owners in the fact that they have responsibility, they have risk. When they purchase the property, they manage the property, they're active. They also sometimes will have to sign a guarantee of the loan. They have legal liability, and they also can contribute either expertise or money. When they contribute expertise, then that means that, say you buy property with your mom and your sister. You may put in money, but you also may have a job. One person may be responsible for leasing. Person may be responsible for the taxes. One person may be responsible for doing the accounting and the books. So general partners can also contribute time as well as money. Limited partners are really silent partners. They're like stockholders. They give money, they have limited liability, they don't have control, they're not day-to-day managing the property. They're just giving money and expecting a return. So show me the money. These are the different ways where you can get money for your real estate deals. First of all, just the regular loans, commercial loans. And then there are private loans, also called hard money. Friends and family, general partners, self-directed IRAs, public offerings, and private offerings. Public offerings and private offerings relate to rules that similar to stocks or securities, which we'll get into. Commercial loans are loans for buildings with 5 or more units. So even though apartments are residential, they're not office, they're not retail, if it has 5 or more units, it's considered commercial. And commercial loans are different than residential loans. They can be given to entities or individuals, which is different than if you bought a 1 to 4 unit property. So a fourplex, that's still considered residential in the lending world. And you could put that in an entity as well. But a lot of times they're giving it to individuals. You buy a house, you can put it in the name of an entity, but you can also put it in the name of an individual. It's based on the property's cash flow, not the borrower's income. So when you go to buy a property that's 1 to 4 units, you go through this whole pre-approval, pre-qualification process, and they look at you. They qualify your income. When you get a commercial loan, they don't start the process. They do look at you, but they don't start the real underwriting process until they have a property, because that's what it's based on. It's the property's cash flow. So if I have $1 million in income, the property is not enough, doesn't earn enough rent to pay the mortgage, they're not going to give me a loan. It's also based on the borrower's net worth, experience, and cash reserve. So experience is really important. If you're buying a 10-unit apartment, you've never managed a 10-unit apartment, you don't know anything about apartments, they're not going to give you a loan, because your ability to pay the mortgage depends on your ability to manage the property, and you have to know how to do that, or bring in a partner that's going to sign a loan with you that understands how to do it, so the bank or the lender is comfortable with giving you money. It can be recourse, it can be non-recourse. You can get it from a bank like Wells Fargo, these traditional banks. You can also get a loan from a real estate financing firm like CBRE. And CBRE was originally their big brokerage, commercial brokerage, where they represent people who own property to buy and sell their properties. They also do property management, but they also have a financing arm, also called Capital Markets, where you can get a loan for apartment building from them. The government has several programs. You can go to HUD. Fannie Mae and Freddie Mac also provide loans for apartments. The terms can be up to 40 years. And usually the interest rate is fixed for a very certain period of time. Usually in residential, you see 30-year loans. Mostly in commercial, the interest rate is fixed for 5, 10, and 15 years, and then it floats with the market, whatever's going on. So you might want to have your plan in mind. I have this loan. My interest rate is fixed for 10 years. I need to be thinking about maybe refinancing just in case the interest rates are higher, and I need to protect myself from that. The loan payments may be interest only, or maybe interest only for a while and then switch over to fully amortized. And also the terms, whatever you get your interest rate, depends on geographic markets called tiers. So when the lender is looking at where your property is, the safest markets are in tier 1. So Bay Area, San Francisco, that's a tier 1. Less risk. They know you're probably always going to have a renter or be able to fill your building with tenants. And if something happens, you don't pay, they probably feel comfortable that they could sell the property and get their money. The further you go out from the metro areas, they're called tier 2, tier 3, etc. And your rates and your terms are going to be different. They may require you to put more money down. They may give you a higher interest rate. They may require higher reserves, etc. They also have higher fees, commercial loans. They also may require a balloon payment because, again, they may allow you to base your payment on 30 years, but they may require the full balance after 20 years. So after that 20 years, the loan's not going to be paid off. You'll have a big lump sum due unless you refinance, which is what some people do. Check out prepay penalties. Be careful about this, especially some of the government programs. They have very complicated prepayment penalties. And then the closing is longer, 45 to 90 days. Private money, also called hard money, is money that comes from high net worth individuals. They have some money, they're looking to invest, and they'll invest it in real estate deals. A lot of times it's shorter term, not so much long-term, 30-year loans like that. And they're taking higher risk, and for that, they're getting a higher return. So usually what happens is you can get it directly from an individual. You can say, I need some money and invest in my real estate deal. This company, this person, maybe they have their own little invest. They're so rich, they have someone to manage their money. You can just get all your money from one person. or their little investing company. Other times you can go to a company who pulls money from different private net worth individuals and then does the underwriting and loans it out to people. When I mean underwriting is when people or lenders, they will look at the property, they'll analyze you, and then they'll say, yes, this property is something I want to invest in, and these are the terms. So that's what I mean by underwriting. They're just going through an analyzation process. So you can go through a private lender who is doing all that work. And the interest rates can be 4 to 8% above the standard commercial loans. And it's really when they look at the property, like the other commercial lenders, they look at the property, look at the value. But a lot of the private money lenders, they look at after rehab value, also called ARV. And that's because they don't have as many protections to collect. They're taking higher risk. They may be a second lien holder. So they want to make sure there's enough value and equity in that property just in case they need to foreclose or the first lender needs to foreclose. They want to make sure they have their money. And a lot of times private money lenders, they will give money for rehab. And so they want to know that after you fix it up, it's going to be worth what you said it's going to be worth. And then also your experience as a borrower, they're going to look at that and your ability to rehab, execute your business plan, whatever you have planned for that property. But at the same time, they don't require as much experience as a commercial lender or as many reserves or as much net worth. They're a lot less rigid, and that's why they're charging you so much more interest. They also can close quickly. They can close in 7 to 10 days, some of them. Almost all of them that I've seen are recourse. That means they can come after your personal assets if you don't pay, and they'll make you sign something that says so. And some of the private money lenders, Coventus, I've used them. They're pretty good. Anchor Loans, Archbridge, and Pivotal. So friends and family is a good place to start. These people already know you and you know them, and there's a trust factor that you don't have to spend a lot of effort overcoming. But even still, because people can fall out over money, I would still put things in writing to avoid confusion. Even though they're your family, I would just be professional, be clear on what you're asking, be clear on how much interest or rate of return you're giving them, how long they're going to have their money tied up, what are the risks, the details of the property. If they're in town, maybe take them to the property, give them a little tour, make them feel comfortable, just like you want someone to make you feel comfortable. Don't just say, give me some money because I'm your cousin and everything will be okay. Be professional about it. Save you a lot of headaches. General partners. These are owners. Again, they have responsibilities. They can contribute money or time, a job. They maybe you split up different tasks to manage and the property, and you assign it to different general partners. That may be your structure. They're also responsible for liabilities, any tenant issues. They're also responsible for debts, and they can have equal or non-equal ownership. So you can do it however you want. You can make an arrangement that, okay, I'm a 10% owner, you're a 20% owner, you're a 30% owner. That means we split up our profits as such. I get 10% of the profits, cash flow every month, and I also get 10% of the equity when we sell. You get 20%, etc. Or you can say, I put in 15% of the money, but I get 20% of all the cash flow and all the equity because I found the property. So I get a little bit more because of the work I did to bring the property to the group. You can do it however, just make sure it's in writing, and also be clear on the voting powers. You can have equal or non-equal voting powers when you have to make a decision. Self-directed IRAs are IRAs that allow people to invest in real estate. So when you have a Schwab account or a Fidelity account, those are very restricted. Your 401 accounts, they're very restricted to stocks, bonds, funds, whatever they have in their account. So there are other companies that you can transfer your money to. You can transfer some or all of your money from your regular brokerage firm, IRA, Fidelity or Schwab, into this self-directed IRA and buy real estate. Now, there are very specific rules against what they call self-dealing, that neither you nor certain relatives can benefit or invest in your property. You can't live in it. You can't collect rents. Anything, profit, rents that you get from the property, if you use your IRA, has to go back into your IRA. You cannot touch it, or you will be penalized. You will be taxed. Treat it like a regular IRA, and 59.5-year rule still applies. So because these self-directed companies, they don't get management fees like the Schwab accounts and those funds, they charge you a yearly fee. It may be $250, $300. And they also charge you transaction fees for everything you do. So if you need to wire money into escrow, they charge you a fee. If you need for them to sign off on a demand or anything related to the property, they'll charge you a fee. And if you want to buy property, or if you're getting money from someone else's self-directed IRA and they're buying a share, be clear and ask them what name goes on the paperwork, because it's not you buying the property, or it's not your friend in their IRA buying the property or buying a share in the property. It's their IRA. So it may be on the paperwork, Anjanette Scott IRA or something, whatever they'll tell you. And then Interest Group is one of the self-directed IRA companies. Accredited and sophisticated investors, another definition. So these terms coming from the Security Exchange Commission, and they've defined these terms and defined these different classes of investors to protect investors. And when you are raising money, you have to be mindful of what the rules say regarding accredited and sophisticated investors. So accredited, there's a long definition. I mean, it could be a company or an individual. But these are the two of the common definitions and classes of people that we run into. So if it's an individual, they have to either earn $200,000 or $300,000 if they're a couple per year for the last 2 years, and expect to earn that same amount this year, or have a net worth of $1 million or more, and it does not count their personal residence. So their net worth has to be everything else except the house that they live in. A sophisticated investor, they don't have exact dollar amounts of how much they need to earn or their net worth, but it's kind of general. It's someone that understands investments. So someone who understands enough of what you're doing or about real estate for you to present this to them and they're not like lost about it. All right. So a public offering, and these are all governed by the Securities Exchange Commission. You don't have to have a specific property before you collect money. You can advertise openly. You can advertise and collect money from non-accredited investors or accredited investors. Both are okay. You have to register with the SEC unless you have a certain exemption. And the legal costs to go through this whole process usually are a lot higher. And you might have to also get paperwork or qualify from each state. And then you can resell the shares in the secondary market, like the stock exchanges, New York, the NASDAQ. And you must adhere to anti-fraud provisions, like you cannot provide false or misleading info. So just be careful about what you're promoting. You know, if you invest in this property, it'll make you rich. You never have to work again. That sounds like a huge exaggeration. That's false. That's misleading. That may not happen. So just stick to the facts. Private offerings. So private offerings are also called private placements. They're usually sold to a select number of investors or institutions, not on the open market like on an exchange like NASDAQ or the New York, but some private offerings, they do allow unlimited open advertising. And I'm going to talk about that in a second. And depending on who you're getting money from, you might need what's called a private placement memorandum. It's a document that has all the risks, the details of the offering, the sources of the money, how it will be spent, basically full disclosure. You don't have to register with the SEC, and you, again, must adhere to the anti-fraud provisions regarding giving false or misleading information. So here are the SEC laws that exempt you from registering, and registering is a big complicated, expensive process that you have to go through and file forms, et cetera, with the SEC. But they do allow you to raise money in certain situations without going through that process. So if you have a public offering, Regulation A is one situation. You could raise either 20 or $50 million within 12 months, and there's different tiers. And for all these, definitely talk to a lawyer. And I have some recommendations of securities or syndication lawyers that will go into this further, and also they can recommend what's the best for what you're trying to accomplish. You may or may not have to register with the states. Legal costs can be high, and you may need to do annual financial reporting for whatever you're selling. Regulation D are for private offerings, also called 506. You don't need to register, but you do need to file a Form D, after you close on the property and sell shares. And then Regulation CF, also called crowdfunding. This was designed to allow investors to advertise openly and collect money from small amounts of money from a lot of different people. But they do have limits on the amount your investors can contribute, and they do have a cap on how much money you can raise within 12 months. So right now it's about $1 million, and you have to go through a crowdfunding portal. Buy the Block, Roofstock, or a couple of crowdfunding portals. So Regulation D, I'm going to talk about that, the 506, B and C, because that's what a lot of real estate investors use when they're trying to raise money for a specific property. 506B has a safe harbor act or provision where you don't have to register from the SEC. You can raise an unlimited amount of money, and you can raise money from an unlimited amount of accredited investors and a maximum of 35 non-accredited investors, or AKA sophisticated investors, people that know enough about investing where you feel comfortable taking their money, they know what they're getting into, etc. You cannot openly advertise, like send an email blast or put it on Facebook or do a podcast. And to address this, most of the attorneys that do this say you have to have what's called a substantive pre-existing relationship, or else how do you know how to advertise? If you can't advertise openly, then that means you have to know people already, sort of. And the whole purpose of knowing people is to understand if your investment is suitable for them. Can they afford it? Can they afford to leave their money in the deal for 5 or 10 years, whatever you require? Can they afford to lose the money? It's not their last dollar that they're going to invest in the next month after you close, ask for it back if they have an emergency. So that's why the substantive pre-existing relationship concept has come about, because as you talk to people, you know enough about them and their profile, or is it a property that they're interested in? Even if they have a lot of money, do their returns that you're offering match what they want? So the only way to know that is by talking to people and getting to know them. However, it doesn't mean that you have to have known people and are best buddies with them for 30 years. There is a suggestion that I have one attorney, he suggested this way: to prove that you have a substantive pre-existing relationship and to know enough about them to see if this is even something you want to offer them. Talk to them. Talk to them at least 3 times over 30 days. And not just chit chat. Ask them specific about what they're looking for. How much money do they have? How much do they want to invest? How long can they keep their money in the property? And then talk to them, each person individually. Call them on the phone. Don't send a mass email. Talk to them individually and ask them. And if you have even one non-accredited investor, you must provide all of your investors full disclosures called a private placement memorandum. However, if you have a very small group, you may not need to go through the full formal private placement memorandum. You just probably talk to them and give them risk. Now, that's not legal, and I'm saying talk to your attorney about it, but private placement memorandum is a lot of work. And so if you know someone, maybe it's one other person that you're asking money for, maybe they're a family member or something, may not need to go through all this, but just think about it, use your wisdom and common sense and talk to an attorney. And then you can't pay someone a fee to raise money for you unless you're a broker dealer. I mean, you're the owner, you're responsible for raising money for your project. And then there are restrictions on reselling shares. So if they invest in a property, and this is why it's so important to know who your investors are. They invest in it, they can't change their mind the next month and say, oh, I don't want to have my money in this property anymore. I'm going to call Schwab, my broker at Schwab, and ask them to sell my share. It doesn't work like that with a private offering like this. So Regulation D506C is another component of 506, which is exempt from registering with the SEC, but you can advertise openly. You can send an email blast. You can put it on social media. However, it's only for accredited investors only, and you have to take steps to verify these people are accredited. You can't just take their word for it or have them check a box on a piece of paper. You have to verify, you look at their financials, their W-2s. There are a couple websites that will help you with this, verifyinvestor.com or investready.com. And again, you can't pay someone a fee to raise money for you, the owner, unless they're a broker-dealer. Private placement memorandum is recommended. You have to decide what you want to share with accredited investors. But if it's people that you don't know, you might want to think about being more formal, especially if you're raising a lot of money from different people, and laying everything out, all the disclosures, so they know exactly what you're offering and what you're getting into, what they're getting into as well. And then again, there are restrictions on reselling shares. There's some rules, there's some waiting periods, there's forms. Again, it's not like you buy, that's why it's a private offering. That's why it's not something you're just going to see in your Schwab account that you can sell the next day. So for 506 Regulation D, you have to file Form D after you close on the property and sell shares. When I mean sell shares, every time you collect money, which is cash from a person that's investing, they own a little bit of piece of that property, which is just like a share, it's like a stock, same concept. And you have to file a form with the SEC after you close on this property and sell these individual shares to these people who invested in your property. The form has details about you, the owner, the state the property's in, the number of shares, so the number of investors, the type of exemption you're asking for. And it's due 15 days after you sell your first share or security. Here's some other documents that your attorney can help you with that you'll need to provide. An investor questionnaire. It gets a profile of the investor. A subscription agreement, which is like an application for the investor to invest and list the number of shares they're going to buy. And then an operating agreement. That's the agreement between you as the owner, the general partner, and the limited partner, the people who are your basically stockholders in your property. Has the details of the agreement, your authority, their authority, percent ownership, their rights, voting rights, all those things are spelled out. Here are some syndication lawyers, Syndication Attorneys LLC, Kim Lisa Taylor. She consults with a lot of different property owners and also has trainings on her website. She's good. She also will give you a 30-minute talk for free, like consultation. And then Cutting Edge, Brian Becken, he is in the Bay Area. He's also someone that you might want to talk to. Questions? Okay, so here are some statistics and data sources. I'm going to always put this on because you always must do your due diligence about where you're going to invest, especially you start with the higher level of where, location, your city, your metro, your neighborhood. And then education resources. These are investors who or lenders who provide information about their experiences to help you invest. And some are local, some are nationwide. You can go online and get lots of free information. And they do this to help people, and sometimes they do it to bring other investors and build their credibility in their company so they can attract investors for their property. JardyMatrix.com, you can subscribe. They do monthly research on apartments and the markets, different cities. It might be a good idea if you're trying to decide where can I invest, where's the market hot, what are the rents, they do trends and all of that. And multifamily insiders are people who are giving you information on day-to-day how to manage property, deal with tenants, things like that. And then NRE Online is another, they do information on trends in real estate. Here's some local education events in the Bay Area, but of course, everybody in the country, if you're in a big enough city, they usually will have real estate groups and meetups. So go on meetup.com, there's plenty of them, and also there are RIAs, REIA, real estate kind of investment advisory groups that you can join. So Virtual Investors Group, they're in the Bay Area, they're in San Francisco, they're led by investors who own apartments and have done investing, and they give different talks, and the networking is good. The next one they're having is January 16th, Oakland Multifamily Real Estate. They are doing a webinar on January 7th at 6 p.m. Bay Area Multifamily Investing Group. They do something almost every Tuesday in Fremont. The next one is January 21st. And then Bay Area Commercial Multifamily, which is Baycom. They're doing something January 16th. They're usually in San Jose. And they do massive syndications all over the country. And they also give a lot of good information. So future topics are getting a loan, due diligence, going through escrow, property management, asset management, rehabbing, 1031 exchanges, and appraisals. So the next one we're going to talk about is how to get a commercial loan, going through that process of you as a borrower getting your documents together and then what they're going to require when you finally find a property. So that's Saturday, February 1st, 2020 from 1 to 3 p.m. Starts and ends one time in the San Lorenzo Library.